Welcome to your presentation on the introduction to costs. So if you remember our income statement, the concept of a cost is simply that the lower your costs are, the higher your profits would be. So remember, revenues minus expenses equals profits. So if you're able to control your costs as much as possible, you should in turn have more profits. So it's always very important for a manager to understand all of these costs. The idea behind this presentation is just to make you feel more comfortable with the different types of costs that are out there. So there are fixed, variable, mixed, step, direct and indirect, controllable and non-controllable, and then there's other costs. These are all different terms that you want to get used to before you go out into this industry, that you can feel comfortable, and it will definitely be valuable for you to understand them as you move forward in your career. So a fixed cost. We've talked about this quite a bit. It's a cost that remains constant despite the increase or decrease in sales volume. Okay? So that's shown in this chart by a straight line, because no matter your sales volume, you're just always going to have those fixed costs. An example would be a salary. So salary is where you're making the same amount every 2 weeks. Your management, your executives would have a set salary, which is a fixed expense. Doesn't matter whether you make more money or not. Property taxes, leases or rent. These are all fixed costs that you have no control over. A variable cost, on the other hand, is going to be a cost that increases as sales increase, and vice versa. Okay, so food, beverage, wage employees, these are the types of costs that we can manage the most as managers. Okay, we can try and control the most. So on this chart, you would notice that at zero sales, we would have zero variable costs. But as we move forward in sales volume, we should see our variable costs go up as well. Okay? Because in order to sell more food, we need to buy more food. Sell more beverages, we need to buy more beverages. If we have more sales, we have more employees. This is true for hotels and for restaurants. Now, mixed costs are really a mixture of both fixed and variable costs. So think about a telephone service in a hotel. Well, there is a set rate that the hotel pays for the whole telephone service for the entire hotel, but then there's also variable expenses that come with long distance calls, that come with more occupied rooms. There is a variable aspect to it, so it's really a combination of those two. Then there's wages and salaries. Notice how they're both labor costs, but one was in variable, that was wages, and one was in fixed, so that's salaries. They're both labor costs, yet they're different. And so we really need to make sure that we're separating the two in order to control the actual variable costs as much as possible. The fixed aspect of our labor costs or salaries, other than contract negotiations, once we've actually decided how much we're paying someone, we can't alter that. But we can alter this part of our labor expenses. Our total cost is when we're really just combining our fixed and variable costs together. Okay? So if you remember, at zero sales, we would have zero variable costs. Well, our fixed costs is always going to be constant, so our variable cost is really just starts from the fixed cost line if we want to add up our total cost. The difference between these two is really our variable cost, because no matter if I have zero in sales, I'm going to have fixed cost, but I'll have zero in variable. So we're just really adding our fixed cost plus our variable cost to get our total cost here. Okay? So combined, they really add up. Fixed and variable combined gives us our total costs. Another type of cost that you might hear about is a step cost. And that's really a cost that increases as a range of activity increases or capacity limit is reached. Okay? So it really goes up like a staircase. The best example would be if you've been a server at a restaurant or just a server at a restaurant. You can typically only handle a certain amount of tables, or you should only be serving a certain amount of tables or guests. The second more guests or more tables need to be served, you would add one more guest, one more server. That would be another step. Okay? That would be one more person. And you typically have these limits in the restaurant industry. For hotels, you could deal with that from occupancy and housekeeping. As soon as we hit a certain level of rooms that have been sold, another housekeeper would be added. And then another 10 rooms sold, another housekeeper would be added, so on and so forth. That is what we would refer to as a step cost. We also have direct and indirect costs. Okay, so this would be direct costs being anything that's directly attributed to a specific area or profit center. Okay? So these are typically going to be your variable costs that increase with increase in sales volume and decrease with decreases in sales volumes. So anything that's directly related to a specific area typically is a variable cost. Okay? And indirect costs, it's not really easily assigned to a specific department. So undistributed non-operating expenses is what we would typically refer to here. So think about your administration in general, human resources, marketing, property taxes. You can't really give that to just one profit center. It's going to be for all profit centers. So it's an indirect cost of operations. Okay? Now, your controllable and non-controllable is exactly what they say. So controllable costs are those that a manager has primary control over. So we've already talked about food, beverage, labor, okay, and the wages part of labor. Again, these are variables. So your controllable costs are typically your variable costs. A lot of the time you're controlling people's actions, right? So your labor, you as a manager, you should be controlling when you're getting rid of people, when you're having so much staff on. Food doesn't just disappear by itself. It was either waste or too much portion or it's been stolen. A lot of the time, controlling costs is controlling people's actions. Okay? Non-controllable can't really be controlled in the short term. Okay? So that's going to be mostly your fixed costs because you have zero control over it. Managers focus on managing controllable costs. Then we have other costs. Okay, so these are going to be a few different costs altogether. So a joint cost would be something like in a, let's refer to a hotel example. So think about a chef at a hotel. Sometimes there's an executive chef that oversees all of the food and beverage profit centers. So banquets may be a profit center and so may be a restaurant. Now the chef works within both of them. So that would be a joint cost. Now you would have to go ahead and try and do some type of calculation to figure out how much of the chef's salary, the executive chef's salary, should go towards the banquet's expenses and how much should go towards the restaurant expenses. But combined, he's really overseeing two profit centers, therefore he is considered a joint cost. An incremental cost, it's really when you're increasing the cost of each additional unit. So every time you have one additional unit, what's that incremental cost? We've talked about cost per occupied room. So every time you have one more occupied room, typically you're going to have an additional cost that you actually take on as a hotel. The cost of your amenities within the room, the cost of anything else that you're going to have to pay for just for one additional guest. Okay, so that would be your incremental cost. Okay. Standard cost is a bit of a different thing altogether. So standard cost is the agreed to cost that should be reached, okay, that it should be incurred given a specific level of sales. So a standard food cost percentage would be the agreed to amount food cost percentage that should be reached. Okay? Standard cost per occupied room is how much it should be. These standards are researched. They're also set by managers themselves. So by what I mean by research is they actually review historical information and then they have a set amount that they believe that cost should be at all times. That's a standard. Okay. Some costs are those that have already been incurred and you can't really do anything about it at that point. So if you're making a decision, the best way to discuss it is really real estate. Or let's say you were to travel to try and decide whether or not you're going to purchase a hotel. The travel cost, you're making two decisions. The travel cost itself, that's a sunk cost. It has to do more with the decision you're going to make. So the travel cost itself has nothing to do really with the decision you're going to make. Therefore, it's just a sunk cost. It's something that you had to do in order to get to a different result. Okay? And then lastly, opportunity cost. Opportunity costs are not really expenses. It's really something that you're giving up when you make a decision. So let's say you have two alternatives for purchasing, okay? Or if even for something that may bring you revenue. Okay? You have two different options. If you choose option A, your opportunity cost is any benefit that option B would have brought you, and that option A does not. So anything that you're giving up by going in one direction over the other, that would be an opportunity cost. It could be in dollars, but it could also just be a benefit as well. It doesn't have to be a monetary thing when we're talking about opportunity costs. Those are quickly all your different types of costs that you might see as you move forward in this industry.